In the world of global finance, we often hear about powerful investors, big corporations, and financial institutions. But there's an unexpected group that has made a significant impact on international markets: Japanese housewives. Over the past few decades, these women have quietly played a role in shaping financial trends that even professionals in global finance didn't anticipate. Known as the Mrs Watanabe traders, Japanese housewives have outsmarted global finance by carefully managing their household savings and taking calculated risks in currency trading. Let's dive into the fascinating story of how this happened. The origins: Japan's low interest rates. To understand how Japanese housewives became key players in global finance, we need to start with the financial environment in Japan. After the economic bubble burst in the early 1990s, Japan entered a period of low growth and deflation. The Japanese government responded by lowering interest rates to encourage borrowing and spending. But this created a problem for savers. For Japanese households, which traditionally save a large portion of their income, low interest rates meant that the money sitting in their bank accounts earned almost no returns. Unlike in other countries, where people might invest their savings in the stock market, Japanese households were more cautious, preferring to keep their money in safer options like savings accounts or government bonds. But as interest rates dropped to nearly zero, it became clear that these traditional savings options were no longer providing any meaningful returns. That's when some clever Japanese housewives started looking for alternatives. The rise of Forex trading. The most popular option for these housewives became the foreign exchange market. Forex trading involves buying and selling currencies to profit from fluctuations in exchange rates. For example, if the Japanese yen is weak compared to the US dollar, traders might buy dollars, hoping to sell them later when the yen strengthens. Japanese housewives, armed with internet access and a desire to increase their household savings, began trading foreign currencies from their homes. They earned the nickname Mrs. Watanabe, a generic term used in Japan to refer to the average housewife. While this term originally referred to the housewives themselves, it eventually became a symbol for all retail Forex traders in Japan. What made their trading strategies so successful? The answer lies in a practice known as the carry trade. The carry trade, a simple but powerful strategy. The carry trade is a relatively simple financial strategy that became the foundation of many Japanese housewives' trading activities. In a carry trade, a trader borrows money in a currency with a low interest rate, like the Japanese yen, and then uses that money to invest in a currency with a higher interest rate, like the Australian dollar or the US dollar. The trader earns the difference between the two interest rates, while also potentially profiting from changes in the exchange rate. For Japanese housewives, the carry trade was an attractive way to boost their returns without taking on the high risks of other investments like stocks or real estate. They could borrow yen, which had very low interest rates, and buy currencies from countries with much higher interest rates. If the exchange rate stayed relatively stable or even moved in their favor, they could earn a steady profit. At the height of the carry trade's popularity in the 2000s, Japanese housewives became a force to be reckoned with in global currency markets. Their collective trading activities were so large that they influenced the value of major currencies like the Australian dollar, the New Zealand dollar, and the South African rand. Outsmarting global finance. What's remarkable about the rise of the Mrs. Watanabe traders is that many of them were not professional investors. These were ordinary women managing household budgets, balancing the costs of groceries, education, and other expenses. Yet, they managed to outsmart some of the world's biggest financial institutions. While global financial experts were often focused on complex models and large-scale trades, the Japanese housewives relied on simpler, more practical strategies. They carefully monitored exchange rates and interest rate differentials, sometimes using basic technical analysis tools to guide their trades. They also took advantage of the growing availability of online trading platforms, which allowed them to execute trades from the comfort of their homes. One key reason for their success was their discipline. Many of these traders approached Forex trading with a long-term mindset, aiming for steady gains over time rather than chasing quick profits. They often use stop-loss orders to minimize their risks and set realistic goals for their returns. In this way, they avoided the kinds of risky behavior that often leads to losses in volatile markets. The impact on global markets. The activities of Mrs. Watanabe traders became so significant that they started to move global markets. In the mid-2000s, their collective trading in the carry trade pushed up the value of currencies like the Australian dollar and the New Zealand dollar. Financial analysts around the world began to notice the influence of Japanese retail traders on currency movements. For example, when the yen started to weaken, Japanese housewives would flood the market with sell orders, amplifying the currency's decline. Conversely, when the yen strengthened, they would buy back the yen, contributing to its rise. This trading activity had ripple effects on international financial markets, influencing not only currency values, but also the interest rates and inflation policies of other countries. What's more, these housewives were quick to adapt to changing market conditions. When the global financial crisis hit in 2008 and the carry trade became riskier due to increased volatility, many Japanese housewives adjusted their strategies. Some pulled back from Forex trading, while others shifted their focus to different investment opportunities, such as government bonds or stocks in stable companies. Their ability to pivot and manage risks during turbulent times demonstrated their financial savvy. Challenges and risks. Of course, Forex trading is not without its risks, and the Mrs. Watanabe traders were no exception. While many were able to make steady profits from the carry trade, others faced significant losses when markets moved against them. One of the major risks in Forex trading is sudden changes in exchange rates. For example, if the yen unexpectedly strengthened against the currency they were trading, the housewives could lose money on their positions. Some traders used leverage to amplify their trades, which meant that even small movements in the market could lead to large losses. Despite these risks, the Mrs. Watanabe traders remained resilient. Many of them took a cautious approach, using smaller amounts of leverage and limiting their exposure to any single trade. This disciplined approach allowed them to navigate the ups and downs of the market and continue making profits over the long term. The legacy of Mrs. Watanabe. The story of how Japanese housewives outsmarted global finance is a testament to the power of individual investors and the potential for ordinary people to influence global markets. While the heyday of the Mrs. Watanabe traders may have passed, their impact on the financial world is still felt today. In recent years, Japan's low interest rates have persisted, but the carry trade has become less popular due to increased market volatility and changes in global interest rate policies. However, the legacy of the Mrs. Watanabe traders lives on in the growing number of retail investors around the world who are using online platforms to take control of their financial futures. In Japan, many housewives have continued to manage their household savings with the same careful attention to detail that made them successful Forex traders. Some have diversified into other forms of investment, such as real estate, stocks, and mutual funds, while others have shifted back to traditional savings options as the financial landscape has changed.